All right, today we are diving into a classic, one of the most powerful signals that traders look for to predict a big shift in the market. It's called the head and shoulders pattern, and really getting a handle on it can be an absolute game changer. So let's get right into it.
So just picture this. A stock or a currency has been climbing for a while. The million-dollar question for every single trader out there is, okay, when is this party going to end? How can you possibly know when things are about to flip? Well, it turns out the charts themselves often whisper clues. Traders look for specific shapes called reversal patterns, and probably the most famous, the most talked about of them all is the head and shoulders. Think of it as a visual story that says, hey, the buyers who were in control, they're getting winded, and the sellers, they're starting to wake up. Now, to use this thing effectively, you first have to know exactly what you're looking for. I mean, every little detail matters. So let's dissect the anatomy of this pattern piece by piece. So at its core, the head and shoulders is what we call a topping formation. It's basically a warning that we might be at the peak. It's like the final scene of a big battle. The buyers make one last huge push to go higher, but they just run out of steam. And that's when the sellers finally get the upper hand. It's a huge red flag that the uptrend might be over. And here's the number one rule, the most crucial part. This pattern only counts if it shows up after a pretty decent run-up in price. You can see it right here on the chart. If the market has just been chopping sideways, it's not a head and shoulders. Context, as they say, is everything. The name obviously comes from its unique shape, which is built by three distinct peaks. First, the buyers push the price up to a high point. That's our left shoulder. Then they get a second wind and push it to an even higher peak. That's the head. But then their third attempt kind of fizzles out. They can't even get back to that previous high, and they form a lower peak, the right shoulder. And that failure right there is a massive sign of exhaustion. Okay, so what holds this whole thing together? It's a simple line called the neckline. All you do is connect the low points, the little valleys, that form between the three peaks. This line is absolutely everything. It becomes our trigger, our line in the sand for the entire trade. And hey, here's a little pro tip for you. Sometimes the neckline is perfectly flat, sometimes it even slopes up a bit. But if you see a neckline that's sloping down, well, a lot of traders see that as an even stronger, more reliable signal. It's basically showing that the sellers are getting impatient. They're starting to push prices down even before the pattern is fully broken. All right, so now you know how to spot one in the wild. But that's only half the battle, right? The really important part is, how do you actually trade it? Well, here is a simple 4-step action plan. The process is actually pretty logical. Step 1, you have to be patient. You wait for the whole thing to form, don't jump the gun. Step 2, you draw that all-important neckline. Now, step 3 is where the action is. The signal to get in is when the price breaks decisively below that line. And finally, step 4, and you do this before you ever place the trade, is you figure out where you're going to get out with a profit. You calculate your target. And that, of course, leads to the next big question. If this pattern is so good at telling you when to get in, does it also give you a hint about how far the price might fall? And the answer is yes, absolutely. And the way you figure it out is surprisingly elegant. It's really just a simple measurement. You take your chart and you measure the vertical distance from the very tippy top of the head straight down to the neckline. That height basically represents the amount of energy that was built up during that whole topping process. And kaboom! Here's what happens next. You take that exact same distance that you just measured, and you project it downwards from the spot where the price broke the neckline. And as you can see right here, it's amazing how often the price will fall at least that far. It's like having a built-in price target. So, you know how in every good story there's always a flip side? Well, the same is true here. This pattern that's so great at spotting the end of an uptrend, it has an exact opposite that works at the end of a downtrend. Let's take a look at the inverse head and shoulders. This little table here lays it out perfectly. The standard pattern, it signals the end of an uptrend. The inverse one signals the end of a downtrend. Instead of peaks, you're looking for valleys. And this is key. Instead of a signal to sell below the neckline, the inverse pattern gives you a signal to buy when the price breaks above it. And here's what it looks like on a real chart. I mean, it's a perfect mirror image of the original. This little guy forms after a long, painful downtrend, and it's a sign that the sellers are finally running out of gas. You see a valley, then a deeper valley, and then a shallower valley. It's a beautiful sign that the buyers are about to come back in a big way. And the best part? The profit target is calculated the exact same way. You just flip it. You measure the distance from the bottom of that inverse head up to the neckline, and then you project that distance upwards from the breakout point. As you can see, this can often signal the start of a really powerful move to the upside. Okay, we've covered how to spot the pattern and how to treat it. But there's one last really crucial piece of wisdom we need to talk about. It has less to do with lines on a chart and everything to do with what's going on in your head once you're in the trade. So let's play this out. You did it. You executed the trade perfectly. The price hit your target, you banked a nice profit, you're feeling great, but then you watch the price keep on going in your favor. And that little voice starts whispering in your ear, "Oh man, I should have held on. Look at all that money I'm leaving on the table." The advice from pretty much every trading book and every successful trader is as simple as it is powerful. Don't be greedy. It is probably the #1 lesson you have to learn. Think about it. You had a plan that was based on a solid, high probability setup. The pattern worked, it delivered the move you expected. The goal isn't to try and squeeze out every last penny from a move. The goal is to consistently execute your strategy over and over again. Taking your profit when you plan to, well, that's what disciplined trading is all about. And that really leaves us with one final thought. When you see a pattern like the Head and Shoulders taking shape on your screen, are you just looking at a bunch of random lines and wiggles? Or are you actually seeing a visual map of human psychology? A story of hope and fear and exhaustion playing out for everyone to see? It's something to think about.